But thank you so much for being here. We are super excited to present the SR7 Wellington opportunity. Before I go further, I want to share with you how I met Didier and got to know about Sphere Healthcare Investments and why I am also personally investing in this particular investment opportunity. First and foremost, I met Didier almost about 2 years ago at this point at a conference where we ran into each other. It was one of those serendipitous meetings. Started talking, decided that we should or start exploring ways to work together, honestly. And Didier had been telling me, and I have noticed myself, and you all also might have, there's a lot of real estate platforms out there. But still, despite that plethora of platforms, it is hard to get high quality, institutional grade real estate opportunities available to ordinary investors like ourselves. Typically, the investments that are available on these platforms are very high risk and not something that institutions would bet their money on. So, there has been a spate of, projects didn't go forth as planned or they ran out of money and so on and so forth. But there is an opportunity there to raise the bar. And at PropelX, I really like to think of ourselves as raising the bar on many things. I feel that we have pursued high quality investments on the startup side of things, and I want to do the same on the real estate side of things. So we decided to partner with Sphere Healthcare Investments to offer some of their investment opportunities to our users. And as you know, currently there are two opportunities available. There is this the healthcare fund, and this webinar is not about the fund. The other opportunity is a specific property, which is located on the State Route 7 in the Wellington area of Palm Beach. Um, Lots of pictures of the property are already there, but um, very specifically, we invited Didier and Dharma to talk more about it, to talk about their history, how Sphere was founded, and so on. And before we venture into their description, I want to share why I'm investing in this property. And that really is because of Sphere Healthcare Investments. All of my interactions with them have been very high quality. And, at this point, we are heavily concentrated in tech because I live in San Francisco Bay Area. So that comes as no surprise. And a lot many tech investors are heavily concentrated in tech. But aside from that, aside from the fact that we do want to diversify, this is really about Sphere and Didier and his team and the care that they have for all of their LPs. And I have noticed that in conversations time and time again, where to the benefit of LPs, I know that Sphere has said, okay, let's not take this fee or let's not take that performance fee so that LPs can have a better outcome. So I feel very confident in investing alongside with them. It's really more a matter of trust than anything else. So with that, I will hand over the floor to Didier and Dharma. Please go for it. Um, do you want to share the slides? You have the slides for, but Didier, I would love for you to start with your how you founded Sphere and the history of Sphere. And I'm quite worried that it's either my audio and my video, but hopefully it is okay to others. But on my side, I am cracking up. I know that. So hopefully it's okay for you all. Okay, great, excellent. I see these thumbs up happening. So people can hear and see you perfectly. Please go for it.
Thank you, Swati, and we can hear you very, very well. So we both, Dharma and I, are very excited to be here. And in a nutshell, Sphere was in fact created in 2004 under the name of Flagler. And we started by investing in distressed assets all over the US, mostly acquiring office buildings and data centers. We did this up to the 2008 crisis. And in 2009, we decided to rethink the entire strategy. And for many reasons, decided that the healthcare sector was a very interesting terrain for us to spend hopefully the next 20 years in creating a refined investment strategy. So we started looking at the sector in 2010. We did our first investment in 2011. And the characteristic of the first 7 years is very important to understand and have in mind, because we really created an engine to allow us, the principal and key partners in the company, to acquire assets. We did not start as a sponsor that traditionally invests 5 or 10% of the equity and is really looking at fees as a business model. We did this primarily to invest our own equity. And that's the reason why since 2011, the first acquisitions, to 2018, we have invested 50% 50 of all required equity in every single asset. So today we own a portfolio of about $700 million of assets. A lot of them are in South Florida. One of them is SR7, and we're going to talk about it. These are assets that we really acquired for ourselves, and we have decided to keep those assets on the very long term. In 2018, because of the way we have looked at real estate investment management and the healthcare sector, and I explained the particularity of that outlook, many institutional investors came to us and say, "We'd love for you to consider co-investment with us." And at that time, we decided to change the model, go back to something that was more conventional, where indeed we created large portfolios, large investment vehicles with 90% of the equity coming from large investors. So the first platform was created with a Chinese group, Fosun. And since then, we have created many vehicles with Nuveen, with Prudential, with many others. We just signed a joint venture with Walton Street Partners. It's freshly signed. We signed it a few days ago. And this joint venture, which will be communicated probably next week, this joint venture is set to invest $450 million in medical office building and other ambulatory assets in the US. Why have we been so successful, not only for ourselves, but for our investors over the past 15 years? Mainly because we had anchored that company into 3 main pillars. One is the team that we have assembled. Contrary to what I have done in the past, we decided to have a team that did not come strictly or only from the real estate sector or the financial sector. We really wanted to have a team that was able to understand the sector. So just like Dharma, who is trained physicians in the UK and spent a lot of years at NHS and joined us 5 years ago, our CIO is a former surgeon, and we have many public health experts in the company. So that was really something fundamental, because as some of the people on this call may know, most of the assets in the healthcare world, in the US, but also in Europe, are still owned by operators, by systems and large operators. So you need to be able to engage with them beyond just a pricing, in order to generate opportunities and show that you could be a very long-term partner. So that was very important. It was also important for us because the second building block of our company is the data. So we have acquired many data analytics platform, and we are really truly data driven, and have created many, many tools that help us to not only inform our strategy, but to identify opportunities and to eliminate bias in all of our decisions on the investment chain of events in the entire activity that we have developed over time. And the third aspect is the verticality. So we don't surrender any important aspect of not only investing, but also managing. We do our own property and asset management, but we also do ground-up development, non-speculatively. So we have the ability to do everything in-house, not because we think that it's also interesting from a revenue point of view, but most importantly, because we really want to have the control of our relationship with our tenant, which we consider really partners in our deal. So that's the company. Today, we have about $1.2, $1.3 billion under management. We have sold many assets. We are selling in January and in February many assets because we are arriving to the end of a cycle for many of our investors. And we have obtained really incredible results. And so we have a great track record. That's why Walton Street Partners as a partner with us to do that particular fund. We have a great reputation. And the reason why we established this relationship, and I remember when we met in Riyadh 2 years ago, is because the challenge of a company like us that is really focusing very narrowly on a sector to become as efficient and as knowledgeable as possible is always the access to capital. And I just throw a big number mentioning $450 million with Walton, but it's not easy for us to go beyond those type of partners, which are the large investment management who directly own the relationship with the source of capital, which are the pension funds and some endowment funds. It's difficult for us to break that barriers. And we have, over the years, think about how can we reach directly the source of capital in order to escape that particular layer, which, as you know, could be very advantageous for us, but extremely competitive, and we are not in control. We are not even, I would say, in the first line of relationship with the source of capital, right? We make them look extremely good vis-a-vis their investors, and they sometimes obviously knows that we are part of the entire complex, but they don't really know that we do 99% of the entire work, right? So it's always worked well in period like now we see where there is a lot of liquidity, but it's always a challenge in the period that are a little bit more complicated. And what was absolutely fabulous when we met you is that we have not been very involved in platform that instead of looking at the pension fund and the big investors, look at the retail investors, right? And we always also realize, because we have a lot of friends and family that are investing with us, we know that they, unless they are friends and family, they don't have access to those type of deals. So in our GP pool, we invite some of our friends and family. I would say most of them are family rather than friends, because you generally don't want to get too involved with friends. But they have been very, very happy with us because the investment are solid, right? So that's really the goal through this project. And just to introduce, and maybe Dharma can talk more after about the investment itself, just to introduce what we have decided to do jointly, common accord with you, Swati, is that to start on the platform, we want to introduce opportunities that are meant for wealth conservation, right? We don't want to provide any opportunities on the speculative side. We will in the future, when we have already established a good relationship with many of the investors, we will enter into deals that are more in the beginning of the structuring for us, a little bit more complicated. But initially, we wanted to show deals where we are heavily invested. So as I mentioned, in that particular asset, we own 50% of the assets, right? The other part is owned in part by physicians that are also tenant in the building. And our goal was to say, we're going to use those assets and we're going to open up part of the interest in those companies to investors coming from Propel in order to offer stability, in order to offer assets that we know of, right? These are not property that are under contract and we need to acquire within the next 90 days. There is no issues on the assets because we have been owning these assets since 2017. It's fully leased. It's performing. We just pay back, by the way, a debt because it was interesting. We're going to refi before we open up to investors in order to have a very solid yield. So that's really the approach. Is coming up on the platform with very solid deal where we are not only the sponsor, but the majority owner of those interests in the ownership of those assets.
Yeah, thank you, Didier. That's why I'm also investing. I'm excited about this new effort between the two of us. Okay. So let's hear it about SR7. So like Didier mentioned, it is already owned by them. So when the money comes in, it's going to replace some existing money. And there is a specific, I think, investor who will be replaced. And we can talk more about that when we talk about SR7, the specific property. But yeah, let's go for it.
Okay, so I can maybe give some quick introduction about the opportunity itself, and I'll try and keep it short, as I'm sure the investors would have read through the pitch deck and would have a good grasp of what the opportunity is all about. So nice to meet you all again. So again, as the team mentioned already, I think it's a great the opportunity is a great flight to safety investment asset, I would think, for stable, durable cash flows in the midst of the volatility that we see today in the equities and the bonds market. It's also an opportunity for us to create impact, right? It's a mission critical investment opportunity. And so I think it goes a long way in having an opportunity like this for our investors. So it is a 20,000 square feet Class A medical office building located in the heart of Palm Beach County. It is fee simple, meaning we own both the land and the improvement, the building itself. It's situated on almost 1.8 acres of land. I'm not sure if we need to show the pitch deck at this time, Swati,
Yeah,
or...
Please do share the pitch deck, yes.
Okay, so maybe what I could do is share my screen here. So
I can also share it if you want.
yeah, maybe if you can just share the one pager there.
Absolutely. Here we are. Oh, you know what? I forgot to share the disclaimer, which I will do. But briefly, everyone should realize that these are all that we're not a broker dealer. Propellex is not a broker dealer or funding platform. If a syndicate is formed, it will be managed by Plank Fund Management Corporation, and these are high risk opportunities. Private opportunities are generally high risk. They could be illiquid. There might not be a secondary market for it, and you might be tied up for a number of years. The returns, as discussed, may not materialize. We'll share the full disclaimer with you, and here it is. You should carefully evaluate the offering and make your own investment decisions. With that, I'm glad we were able to get that out of the way. Here is our office building. Continue,
Yeah.
please.
Yeah, thank you. Yeah, so it's strategically located. Yeah, sorry,
go ahead. There are some better pictures of it on our platform and video as well, but please go for it. So it's the 20,000 square foot.
Yeah. So it's strategically located on a high traffic thoroughfare, which is State Road 7, which is how the property was came to be named. Almost 64,000 vehicles on average every single day. So what we call AADT. So offering great visibility and accessibility. The Palm Beach County is, as you know, is a very wealthy submarket, and it scores also very highly on our HBSA metric, which is mentioned over there in the second row. It ranks 176 out of 3,142 counties in the US. HBSA stands for Health-Based Statistical Area. We've just released a document, or almost like a blog post about this, and we can certainly send you a link on that. This is a proprietary ranking system that we've developed in-house to rank all counties in the US in terms of how favorable the market is for healthcare operations. And so the lower the ranking, the more favorable the market is. In this case, 176 ranks in the top 95 percentile of all counties in the US for healthcare operations. So it indicates high healthcare demand and therefore high revenue generating potential for our tenants. The building is also in close proximity to referral networks, predominantly health systems and physician groups. UHS, Wellington Medical Center is very close by as well, with good relationships with our tenants in the building. There's almost 6 parking spaces per 1,000 square feet, which is very high. It's ample for an outpatient center. We typically look for 4 to 5 per 1,000 square feet, and here in this case we have 6. So it's great. It was constructed in 2009, and Fresenius was our first tenant, and they are also still the anchor tenant. They are publicly traded, one of the top kidney care institutions across the globe. They are based in Germany, and we do know the corporate team in Germany as well. You can Google them. They have they are listed in the New York Stock Exchange with the ticker FSN. So you can look into them. We bought the property in 2017. We renovated it and brought it to spec and brought in a top orthopedic group called OCPBC, and they're occupying the top floor. So overall, you have 20,000 square feet across both the floors. The building is, as Didier mentioned earlier, 100% occupied. Both groups are paying about $32 per square foot, triple net. And triple net would mean that there's zero landlord responsibilities. All the operating expenses, such as insurance, property taxes, common area maintenance costs, and utilities are all paid by the tenants themselves. So the rent that we generate, which is about $691,000 today, annualized for 2026, it's the net income to the property, if you like, as you see in the pro forma, which is, I believe, on the next page. The escalations of the rent is about 3% every year, as you can see here, $691 in year 1, going forwards to the following years, it's escalating by 3%. And that is the net income to the opportunity, as I mentioned earlier. The building is valued at $11 million. We are raising $5 million in equity, of which 40% is reserved for Propel investors, which is about $2 million, which is our raise and our ask today. In terms of the cash yield, we're projecting a 6.2% average annual cash yield that is represented at the bottom over there across the 42-month investment horizon. And our XIRR, the most modest XIRR, is about 10.21%. And that includes an exit in the 42 months, as you can see here, 10.13%, an exit cap rate of 6.25. And that gives you an equity multiple of 1.43. That's the most conservative model that we have. I'll stop there for any questions you may have, and maybe turn it over to Didier to discuss our strategy for the building and how we hope to generate such returns across the investment period.
Before we move further, I just want people to know what is the meaning of cap rate. Cap rate means it is the percentage of the value. So what is the net operating income as a percentage of the value? And that is that. In other words, currently or at the outcome, net operating income will be 6.25% of the value. Now, what does that mean? The higher the cap rate means net operating income is a higher percentage of the value, means the value is lower. So ideally, we want the cap rate to be lower and lower. So if in the most aggressive outcome, we could have a 5.75% cap rate. In other words, this net operating income, which we know is fixed because this is by the rent, by the tenant lease, we know that this is fixed. So it's really the denominator that's changing. So if we have a lower cap rate, which means the net operating income is a small percentage of the total value of the company, which means the value of the company is larger. So that's one thing. This is equity multiple. So if we put in 2 million, it could be 1.64 times in 5 years with a 14% XIRR, which is realized. And this 14% means that we are getting a 6% every year. And then on top of that, we'll have about an 8% in appreciation. With that, I just wanted to get the definitions out of the way because most of our users tend to be startup investors. So I wanted to make sure that they understand this. Didier, did you want to add anything to what Dharma just mentioned?
No, I think this is that was fairly comprehensive as an introduction. So I would rather give the floor to any questions.
Okay, fantastic. So people, please ask your questions. And let's just make sure I am seeing the questions. Here we go. So there are questions, and how are these investments being allocated? I'm not sure what that means. If you could just please describe what that means. But in the meanwhile, I wanted to talk about the whole tax implication. And okay, what provision is being made for capital expenses going forward?
So it's a good question. As the Doma mentioned, all of the two leases that we have are absolute triple net. So technically, if we were to have to replace the roof, we could pass through the expense of the roof. The fact is, we generally, since we acquired this asset in 2017 and did a major refurbishment and maintain our assets in a very good shape, there are no major capex to be foreseen for the next 5 years, and the operating expenses pass through to the tenant are really in market and standard. So there is no requirement for capex that we have for the next 5 years, and we will not have undue burden on the tenant. Since nothing major in terms of systems is required to be done.
Thank you, Didier. So I have a question, and this was something that came to us via an email as well, in the conversations that I've had. There are two questions that we've had discussions around. One is the performance of the publicly traded REITs. I know that I think there's a follow-up question that Dennis has. We'll answer that later. But on these publicly traded REITs like MPW and so on, MPT, which are publicly traded REITs of medical office buildings, they also tend to have to 7%, right? Returns. How is that different from our returns? And I know we discussed this over email, but I just want to make sure. Oh, I'm sorry. Am I sharing screen? Apologies. I want to make sure that that our investors understand that.
Yeah, so one of the main difference from an investment point of view is that when you buy a share of a REIT, you have a de facto liquidity, right? You can sell that particular paper quickly, which is not the case if you invest as a member of an LLC that own an asset. You are going to be constrained on the exit. We generally provide mechanism if someone has a need, right, for the retirement or the redemption of their investment, but generally you have constraint. You don't have the liquidity. The also other advantage on a REIT is that the larger the REIT, the larger the distribution of risk, because your investment is allocated through the entire portfolio of investment of the REIT, right? The problem that we have seen over the years is that when you have such an event as COVID or any other major crisis, you are, I would say my experience with REIT is that they are much more exposed. Why? Is because their level of scrutiny on the buy side is much lower. I am not going to speak specifically of any of those REIT. I could, but I will not do in public for sure. But I just would say that it is our experience that because of the amount of liquidity that those REIT have had over the years, their investment strategy is much less sound because their primary objective is really to grow, is scale rather than quality. So we have seen what you see is that if you look at the nature of the transactions, you see a lot of REITs buying large portfolio from other REITs, right? They are not going in the trenches like we are trying to buy assets on the sell and lease back from systems, from physician practices, or putting things together, or even doing development. They need to deploy a lot of dollars. They buy a lot of assets, and we think that the level of intelligence and criteria in terms of selections are much lower. And you see it with the price of those shares today. If you look at the tendency outside of NPT, which is the MPW sign, you see that there is a favorable growth and decent return before COVID, and everything plummeted we think, during COVID and after COVID, right? And that's why you have a lot of shift today in strategy. Welltower has unloaded and sold most of their MOB's portfolio recently to Ken Anderson and Remedy. And they have invested $5 billion 6 months ago, 4 months ago in the UK in the nursing home space. So shifting a lot of their strategy when you see a lot of others flocking or going through investment in the MOB in the US. So it's hard to really understand the logic behind a lot of their strategies. And I would say that that's the reason why I think they're more exposed to those big shifts in tenancy. And unfortunately, they are on the wrong side of the equation, but they will go back, right? They will go back and will be able to stabilize their share value and provide decent return over time. You don't need to be very smart, and I told you that, and you don't need to be very, very smart in real estate. The tenancy generally is favorable to everybody, and everybody is doing fairly well. I think the criteria to select a sponsor or an investment is really to analyze what has been the performance over a very long period of time, not 5 years, but 10 or 50 years, and how have they handled those periods of crisis, right? How did they fare?
Yeah, there is a follow-up question, which I think is relevant here. If I can get 5% on a treasury bond, the additional annual earning here is 1%, and then possibly increased value at exit. Correct? Correct. Right?
That's correct.
What is the strategy to manage a market downturn, if any?
So, to the first question, the way we look at it, we believe that any investment in real estate, and let's talk about core and core plus assets, good assets, should probably be about 150 basis points above the BAA bond, right? Which, if you look at the BAA bond tendency over the past 30 years, and you look at average cap rate for all asset type in real estate, right, commercial real estate, you'll see that outside of the period of crisis, where those two curves tend to be very close to each other, you will see a strong positive correlation, and you will see that there is between 150 and 200 basis points of difference. That's a premium for the lack of liquidity. And that's, for us, really what we need to have in terms of spread to justify the risk that you take in real estate. Again, outside the period of crisis, where you see those two curves to be almost the same, simply because in period of crisis, people realize that real estate, rather than bonds, is a great protector against inflation. And there is some type of ceiling of deterioration that you would see in real estate. Even if you look at the very high period of inflation in the US, you see that the cap rate in real estate, good real estate, never went above 9%, right? So that's so I would agree that you need to look at what you could get. Obviously, Treasury is much lower than 5, but what you could get today in a very good bond, and I would want to have a spread in order to justify the risk that you have in real estate. So that's question number one. How do you avoid crisis? You avoid crisis in real estate if you're not forced to either sell or restructure your rent roll in period of crisis. So you need to have the ability to select and decide when you sell. Because if you are not at risk in those periods of crisis, if you don't have to refi because you have a long-term financing in play, or you have smart leverage, right? You cannot take too much risk on leverage, then you can escape those period of time, which was the case in 2023 and 2024. Anyone that had to refi in 23 and 24, unless you had reasonable leverage and good property to sustain the increase in rate, you would be in difficulty. If you had to sell because you had no other choice, you would have also a lot of difficulty. If for any reason you've lost your tenant, it would have been a catastrophe to find a replacement. Right? So you want to be in a position of strength. You want to be with long-term tenant and leases, and try to be very smart in order to avoid those situations if for any reason you have either a black swan as we have had, or a more imbalance in supply and demand, which is more classic in terms of crisis for real estate.
So in this instance, for example, the leases are tied in, the tenants are tied in till 2032. The tenants are high quality tenant, like Dharma mentioned, which is Fresenius. So we are assured, or there's no assured guarantee of anything, but we are reasonably assured of rents coming in, even if there is a downturn. Additionally, the leases are triple net, which means any changes, improvements, etc., we don't have to bear any expenses out of the rent that we earn. The lessees or the tenants, they bear all the expenses. So our cash flows are somewhat protected. They are long term tied in tenants, high quality tenants, and we don't have expenses on those. So that is, I think, the strategy to manage a downturn gets set long ahead, long before, in the structure of the deal and the tenants that you pick. So that is, I think, the answer to that. Another question that we had here is, so they were talking about capital expenses. Follow up on that. What provision is made for capital expenses going forward, specifically HVAC replacements, parking lot repaving, etc.? My understanding is it's a triple net lease. So, but if you want to answer it, please do.
Yeah, so indeed, it's a triple net lease. We have, nonetheless, when we bought the building, the lease with Fresenius was already in place. We bought this building 50% occupied. The lease was in place. We renewed the lease. The lease that Fresenius had is not a full triple net. We would be responsible for roof and HVAC. So we would not be able to allocate 50%, for example, of the cost of the roof to Fresenius if we had to invest in that particular part of the building, right? That's why when we redid the building and when we refi, we allocated the funds in order to be able to contribute at least those 50% of the capex. Today, the building is in extremely good shape. We have we don't have any expectation of capex. There is only one aspect of the elevators. It's a one story. We have one elevators, and we are doing that particular investment as we speak. In great part, it was elevators is only part of the lease of the tenant on the top floor. Fresenius is on the ground floor. So we are contributing, even if technically the entire cost should be passed through. We are contributing because we have great relationship with the second floor tenant. And by the way, they were until very recently also investors in the transaction. When we acquired the building, the second floor where OCPBC tenant were physicians that invested with us. That's why we were able to buy a 50% empty building and be fully leased when we acquire with OCPBC. So that's our contribution. But to make it's a long story to say that the building is in great shape. We're not anticipating any capex in this building. Again, it's only roof on a 2-story building. It's only roof and system. The plumbing is in great shape. So there is, roof and HVAC in great shape. When we extended the lease to Fresenius, we provided them with some TIs, tenant improvement allowance, in order to be able to get the conditions we wanted in the expansion. And we contributed their HVAC, dedicated HVAC system is much more complex than the one that served the second floor because it's a very large dialysis center, very sophisticated. So they have made a substantial investment in totally refurbishing their systems, and that was less than a year and a half ago.
Thank you. Then there's this question about how the investments are being allocated. How is the raised funding allocated? For example, what we will raise, for example, in our SPV, $2 million, how will we allocate that to operating costs, maintenance, etc.? The answer is no. Please go ahead.
Yeah, it's 100%. I mean, there is every dollar invested here will generate the return and take a percentage in the membership, right? So currently, you have two set of members. One set is, as I mentioned, 50% the principal at Sphere, and another set is a very friendly investors of ours that took the positions last year of the physicians, right? They acquired 50% in the building from the physicians, right? And the idea, we also for when this particular investor acquired the physicians, we decided to pay down the debt. So today, the building is owned free and clear. The transaction that was done was on the price of $11 million, which, by the way, it's exactly the price. We're passing through the exact price that the investors who entered last year paid, which is important, right? And today, we have $11 million of equity in that building, and we want to refi before we will open up the membership interest to Propel. We will probably put between 55 and 60% of that, right, on the property in order to improve the return, right? We have already engaged with many banks that works with us to make sure that we have the right debt. It's probably going to happen in the next 2 to 3 months, and then we will open up. And the idea, as we mentioned, is to allow investors from Propel to invest about $2 million. That's the goal, right? Which mean let's take simple numbers. If we were to put 50% leverage on the building before Propel come in, we will have, right, return to us investors today half of the value, $5.5 million, right? And we will still have $5.5 million of equity in the deal. This $5.5 million will then be open to Propel, and Propel will, if Propel acquire $2 million of the 5, Propel will have close to 40%, right, of the membership interest, right? So we are going to stay in with significant equity in the transactions, but allowing Propel investors to come in with a decent share of the transactions.
So you will continue to own about 60% of the equity,
yes.
And we will. Okay,
yes.
Great. Thank you. Next question is, so hopefully that question is clear. If there are follow-ups, please continue to ask them. Do you know the % of tenants' revenues that are from Medicare and other government agencies? This was something that we discussed, Dharma.
Yeah. So we ask our tenant to provide us financials. So we have a very, very clear and precise idea of the mix, the payer mix for OCPBC, because of the lease that was signed before we entered into, and the power of a large publicly traded company like Fresenius. They have refused to amend their lease in order to allow us to receive from them financials. So we don't really know exactly at that particular property, but we have benchmark nationally. And I can tell you that from our data at OCPBC and the data that we know from national benchmark on nephrology and dialysis, it's more than 60% CMS, so Medicare, right? We have very, very almost no Medicaid payment on OCPBC. It's about 60% Medicare and 40% private pay. But orthopedics in general is well reimbursed. I don't have the at my fingertips the difference between private payers and CMS for some of the large CPT code that OCPBC does, but it's well paid in orthopedics in general. CMS is the compensation is very fair. In general, you would say Dharma, it's what 1.1 time 1.3 times more for private payers and CMS?
At the national level, yes, it could be more than 1.5 or above. Medicare
Okay.
would be the commercial pay rates. Yes.
So
Okay.
but it's about 60, I would say 60-40 as far as we know.
Yeah. So per the benchmarks, about 60-40. We don't know about the first floor, but on the second floor, it's thereabouts. Okay. One more question that had arisen in my discussions prior to this with some investors was the question of tax protection. And I want to share what we have received. So Sphere Healthcare has shared there's something called a cost segregation analysis, which they had recruited an agency to do that. We have received the cost segregation analysis. That basically is a study. So just taking a step back, when you acquire a building which has all this equipment and specialized equipment as a specialized hospital building, that equipment depreciates over time. Now remember, we are getting rental income from our tenants, and what we can do is we can reduce it by the depreciation to reduce our taxable income. Now, how much can we reduce it by the depreciation is a big question here. So typically, this building has been revalued last year, which means we can reduce it by a largest number. So we will have tax protection. And I looked at the analysis. We'll share it on the PropelX platform. We are not tax advisors, and neither is Sphere Healthcare Investments. Eventually, on the property itself, their accountants will give us the depreciation that they captured for the year, and hopefully if they do a great job, then my best guess is we will be able to capture almost all of the rental income in depreciation, which means we'll have to pay a small amount of tax, if any, on our taxes. Again, that depends on everyone's personal tax situations and so on. But that is an important point. My question to you is, so with that is just background. With with that background, I wanted to ask, I know that we had a new tenant who entered last year, and so will we be capturing, because there is something called an accelerated capture or a bonus depreciation capture, where you can depreciate large part of the asset in the very first year, and then you still have remaining depreciation over the next 5 years. I mean, the first 5 years are most important. You get the most depreciation. So I just wanted to understand if we will already be capturing the most part of the depreciation for this other tenant that you got in last year or not.
So the response is no, exactly because of what you mentioned. It's not based on the tenant, it's really based on the investors. The investors that acquired the 50% from the physicians last year at a price of $11 million, wanted to make sure that we could have an accelerated amortizations or depreciations schedule by doing these cost segregations in order to benefit at the year of investment, right, for 2025, benefit from an accelerated depreciation. So generally, when you do a cost segregations, you want to get in the first year a larger portion of the depreciation that you would normally get as an increment, the same increment over 39 years, right? If you don't do a cost segregation and an acceleration of the depreciations, you would depreciate the entire value of your asset over 39 years, and every year you get the 39th of that particular value as depreciations. If you do a accelerated depreciations, you have the opportunity to get much more of the depreciations on the first year, which obviously diminish or lower what you're getting over the rest of the 39 years or 38 years remaining, right? So in that particular case, we can send you to all your investors this schedule, and everybody knows exactly how much depreciations will be shared pari passu to all of the members in 2026, because the investment that PropelX investor will make will be in 2026.
Yes, that would be fantastic. I mean, that's what I've asked for. I do have the cost segregation analysis, but
Yes.
I want people to do some back of the envelope. Okay.
Yes.
Now, according to that cost segregation analysis, there was 8.22 or some 8.8 million that is allowable. Let's just say 9 million ballpark numbers. Now, if this were to be depreciated over 39 years, roughly 40 years, we would have about $210,000 of depreciation every year,
Yeah.
even if we followed straight line. Our net operating income is about 700 plus thousand. So, in other words, we are the floor, the bare minimum that we'll get is 30% protection, and then more on top of that, right?
Yes, again, as you say, we're not a tax consultant. It depends on everybody's tax return. What we can do is share this cost segregations, and everybody should really talk to their accountant to really understand how it works, and based on their personal situation, see how much of the revenue, right, the yield, the distribution that will be done on a quarterly basis, how much of this total revenue could be impacted by the depreciations at the end of the year, right? And reduce obviously their base for tax purposes.
Absolutely. So there is a follow-up question which I'm going to answer. How much of my investment can I depreciate individually in year one? Is it dependent on the LLC decision? I will answer that question. Yes, it is dependent on the LLC decision. To tell you how it works, there already exists an LLC which is Sphere Health, owned by Sphere Healthcare Investments. We are creating an SPV that will go into that LLC, right? So there's LLC, then our SPV will go into that. Whatever Sphere Healthcare Investments decides to depreciate, I'm sure they'll take the best decision in their own interest, right? They will take the best decision to depreciate as much as possible. They will give us the depreciation then that we have taken. Our rental income was 700,000 something, and we have taken this as depreciation, and the final income is whatever, whatever 200, 300, whatever it is. They will tell us that this is our portion of it, which we will then, firstly, we will distribute the larger amount in cash, but we will then prepare our taxes just taking that. So it is not a decision per se to be made, because we are just basing our decision on Sphere's decision, but it is not individual in any event. You will just get the K1 and that will be it.
Yes, I just want to add to that, outside of obviously what is going to happen in 2025 because of what we did, the cost segregations, whatever the depreciations are for the following year, the standard in our company is that it is distributed pari passu to the investors, right? We don't have, there is nothing in the upper agreement that everybody will participate in that say or would say that we take a larger part or a disproportionate part of the depreciation. They are distributed proportionately, so every member has the exact proportionate share of the depreciation based on their membership interest.
Yeah, exactly right. Now, there is one more question. If time permits, can we go over the fees? Yes, let us go over the fees. So the fees are, it's 1.5% of management fee, which will be deducted from what we send to you, right? Out of that, 1% goes to Sphere, 0.5% comes to Propellex. And then there is a carried interest, which is or performance fee, and Sphere has waived their performance fee, and we will be charging a 5% performance fee over a preferred return of 8%, right? So for the first 8% we get nothing at all. Anything above of that we will charge a 5% performance fee. So hopefully that is clear. If there's any further questions, let us know. So that's it. We are at the end of our time. Is there anything else that you wanted to add, Didier, Dharma?
Oh, just on that point, it's quite rare that you're going to see that the sponsor doesn't take any carry interest. I don't think that we're going to continue doing this on the platform. This is really to launch the real estate deal, and it's a very unique propositions. We have carry interest with all of our institutional investors. Generally, they are above either historically either 7 or 8. We have never have a pref above 8, and the carry interest the lowest we have ever done is 15%, up to 25% above the pref, and sometimes it can go even higher in transfers. So having no carry interest from the sponsor, just a carry interest for Propel X for doing all of this work, I think it's quite an exceptional proposition for an investor.
And for that, I mean, this is just one example. I felt that, to make this a successful thing, but it was always, I mean, when we did the calculations, we felt that, oh yeah, we should just, how can we juice up the return for investors? And Sphere was kind enough to say, oh, we'll waive our carry, which I am grateful for. Thank you very much, Didier. Thank you, Dharma. Great opportunity, and thank you for being with us on the call.
Thank you very much.
You were saying something?
No, thank you so much for the opportunity. Great to be here.
Likewise.
Thanks,
Bye-bye.
Swati.
We'll be
Bye-bye.
available. Yeah, bye.